Sentiment last week was gloomy in most places, other than the US technology stocks, of course, and this week kicks off with a lot of questions and a lot of worries regarding the political situation in France and in the UK, the less than ideal economic data that we had this weekend from China, and the sustainability of the gains in the US technology stocks, given that, well, they are the only ones that do well right now and they look like they are somehow amply valued. So, welcome to the new week of trading with Swissquote's daily market talk. So last week was brilliant for the major US indices, but quite gloomy elsewhere. The S&P 500 was slightly down on Friday, but the index posted its best weekly advance in a month on the back of a surprise easing in the CPI figures that we saw in the US and a not too hawkish Federal Reserve statement where the interest rate cut projections on the Fed's dot plot were cut from 3 to 1 for this year. Yes, but that was mostly priced in, remember. So the Federal Reserve watchers were quite served a more confident communique from the Fed regarding the progress of inflation in the US from none to little progress, and the Fed members penciled in more rate cuts for 2025. So all that didn't really bother those investors who are long the major US indices. On the contrary, Nasdaq, for example, closed last week while having renewed record every single session. The AI rally was fruitful, to say the least about that. Now, elsewhere than AI and the US technology stocks, however, things were less cheery. Other sectors than the tech didn't perform well in the US as well. SPDR's energy sector fund, for example, continued to diverge negatively during the course of last week and fell around 3% during last week's trading, as the negative divergence of the financials of the S&P 500 became more evident as well. The Russell 2000, on the other hand, fell to the lowest level since May, and US crude is consolidating near the $78 per barrel level this morning. It looks like the positive momentum there is dying out as well. And beyond the US and energy, last week was quite gloomy as well. Stocks in the Chinese CSI 300 fell below their 200-day moving average and extended losses to more than 5% since the May peak. The latest data show that home prices there slid at a faster pace in May, and that despite all the efforts that the Chinese government puts in to stop the bleeding in the Chinese housing sector, and industrial production also grew much slower than expected by analysts as well during the same month. Now, the People's Bank of China is expected to maintain its interest rates unchanged at this week's monetary policy meeting, but some economists at Bloomberg believe that the week could actually bring a 10 basis point cut in China to prop things up. Now, in Japan, the stocks took a dive this morning to the lowest levels in more than 2 weeks. Even the Bank of Japan's quite accommodative monetary policy stance last Friday couldn't cheer up investors, and stocks in Europe lost 3% during the course of last week as the French election jitters ended in tears for the French CAC 40 index, which actually tumbled more than 6% compared to the previous Friday's close. So as a result, in only 1 week time, just since Emmanuel Macron called for a snap election a week ago in France, the French stocks lost all of their 2024 gains, slipped below a major Fibonacci level, which is the 38.2% Fibonacci retracement on last October to this year rally, and they are now in the bearish consolidation zone. And there is only more political turmoil ahead of us, because the weekend, hasn't been about relaxing and enjoying a fresh glass of rosé in France, obviously. Thousands of people took the streets in France during this weekend instead to show their opposition to the far-right rise in France, but Marine Le Pen's party is still seen amassing more than 30% of the votes in the upcoming legislative elections in France. And because conservative policies never bode well with investment strategies and investment prospects, we will likely see the French markets under a continued downside pressure this week as well. So looking at the spread between the French and German 10-year yield spiked past 80 basis points last week. This is the highest level since the debt crisis that hit the Eurozone more than a decade ago. To give you just a little indication on how unpleased investors are right now with the scenario of France shifting toward, say, too right. Anyway, in this respect, you also see why on earth the US big technology companies are, seen as not only offering to investors a beautiful dream, but also act as, a safe haven to investors who do not necessarily want to deal with the political and the geopolitical tensions here and there. And this is certainly why we also see the US dollar gain momentum to the upside. The US dollar index actually successfully held ground at the major 38.2% Fibonacci support on year-to-date rebound, has brushed off the post-April weakness and looks ready to extend gains toward the upside. Some of the gains are going to be about safe haven. The euro dollar, on the other hand, tanked below the 106.70 level on Friday's trading session and is trying to hold on near the 107 psychological level this morning. But the French political turmoil and the widening yield gap remain supportive of further losses in the single currency in the coming days and weeks. An extension of the sell-off in the euro dollar toward the 105 level wouldn't be surprising or wouldn't be overstretched. In Japan, the dollar yen has, pretty much no reason to reverse given the Bank of Japan's reluctant stance regarding any monetary policy normalization. It looks like Japan will never ever have a normal monetary policy ever again. In the UK, cable also kicks off the week on quite a negative note. Now, while this week is expected to be quite slow from an economic data flow perspective for the US, where attention will mainly on the US retail sales data and the Federal Reserve members' speeches. They're allowed to speak again. The week will be interesting for the UK because the latest British inflation figures are actually due on Wednesday, and the Bank of England decision is due on Thursday. Now, inflation may have eased to the 2% level in May in Britain, right on the Bank of England's monetary policy target, but the BOE is not expected to cut its interest rates before the July general election in the UK, and inflation is seen rebounding toward the 2.5% level in the second half anyway. But a sufficiently soft inflation read from the UK this week and a sufficiently soft Bank of England statement could actually fuel the expectation of an interest rate cut in September in the UK and one more in December, and could encourage the sterling bears to push cable into a medium-term bearish consolidation zone as well. The 126.45 level is the key Fibonacci support to watch that should distinguish between the continuation of the actual positive trend in cable and a bearish reversal. Elsewhere, the Reserve Bank of Australia will also give its latest monetary policy verdict tomorrow, and the RBA is expected to maintain its policy rate unchanged at this week's meeting and keep its relatively cautious stance regarding inflation in Australia. The Aussie dollar remains, in the positive trend for now. It is supported by a relatively hawkish RBA and the reflation inflows, but the bulls could rapidly get caught on the wrong side of the trade if we see a slide below the 0.6580 level. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.